folks, Scott here, and this is the wrap for Tuesday, July 23rd. So before I talk about today, let's talk about what tomorrow may bring based upon what happened today in part. One of the things you actually can't see easily there. Let me go to the daily cash indices, S&P 500. The cash index for the S&P 500, which is arguably the single most powerful tracking index and most important instrument in the world for what's going on, certainly here in the U.S., put in a new high. It's hard to see, but just trust me. If you go double check your charts, a higher high today. It actually makes it a new 200-day or multi-100-day high, but did not put in a 200-day high close. It closed lower. Not only do you see the red candlestick, which means it closed below the open, but if you actually go check, or you can look at those numbers there, closed 1692 versus 1695. You can see the high just above it. Yesterday was 1697 something, and today was 1698 something. So not much, but still it's an interesting point. We put in a higher high, but could not finish with a higher close. So it begs the question: how do gaps fare when fading them following a new 200-day high, but not a 200-day high close? And there you go. Also, it happened 50 times in the past 10 or 11 years. Odds about 50-50 in terms of which way we're likely to gap. Maybe a slightly better chance for gapping up. The sample size is a bit small to make that gross assumption. So I call it 50-50 and maybe a slight edge for buying down gaps versus shorting up gaps. And I will tell you, I did run this number just now for our members in the trading room and showed that up gaps were indeed a little riskier than shorting up gaps were a little riskier than buying down gaps. Not terrible, but again, the sample size isn't too great, but not great either. So a little bit more attractive to look for a down gap than an up gap tomorrow based upon this one particular scenario. All right, let me show you today's. We'll start with the worksheet, which is where I normally start my own analysis, because it's just the summation of the 8 individual gap guides. And I start here, and if it's attractive, then I'll dig in further looking at the markets I plan to trade, which is generally the S&P on the gap. So for the worksheet today, the average of all 8 indices showed that opening above the highs, which is to be honest, I think we opened just above it. It may have been just inside of it. I'll double check in a second. It didn't matter because I was fading at either place because these numbers here. I'm looking for a minimum of 60% win rate when targeting gap fill. This assumes our MTG stop parameters like it always does, and a profitability of at least 1.3, meaning it's made at least 30% more in profits than losses. This is a ratio, profit factor. So pretty much when you see numbers this strong, unless there's a lot of risk factors down here for you in terms of unique patterns, unique day factors, and anything else I may look at, I'm generally trading it. And you see there were no other unique day factors. We nearly missed, forming a doji per my criteria and nearly missed an NR 7-day per my criteria. So nothing else unique. And also note the extended target odds. Take these numbers here, divide them into here, and they were greater than 80%. And profit factors were pretty much if profit factors within 80%, that meets my criteria too. So this is a ratio of these two sets of numbers. So, I'll show you the gap guys super quickly. So you can see the ES, which is my primary. In fact, let me just double check on a different screen where the market's opened. The ES opened 1693.75, so 3 ticks above the high. Sorry, I should have known that. Just couldn't remember. Had my head way down in some good research, which I'll be talking about later in the coming weeks, I hope. Let's see. So UH zone opening above the high of an up day, historically attractive day. This is normally a problematic zone, but it met my criteria day. And a UHC zone also very attractive. Dow was a little more neutral, opening above the highs, but a little bit better in the UHC zone. Sort of mixed in the Nasdaq. Good, excuse me, good profitability, but the shallow means smaller sample size. A little bit of concern there. And then the Russell In fact, it opened in the DHO zone. That was the concern today, or was trading it in most of the pre-market. And the Russell looked attractive in either scenario. Looking at the ETFs, Spider totally confirmed the ES, which is what you expect good systems to do. I mean, if you consider this is a weighted average of 3 different systems that have not been ever optimized with CurveFit, which is a huge risk factor, the mistake most people make. Applied to 2 correlated, highly correlated markets, but different instruments. So you expect them to be similar most of the time, and they are. Diamonds confirmed opening above the highs was a good setup. Q's DHO zone was problematic, but if opening above the highs was good, and then the Russell also looked good. So overall, pretty darn good setup there, and that's essentially what I say here in my pre-market comments. Last night's video tip, this particular range of, if you will, above the 10-day moving average, good. Using MTG style parameters. After a single daily doji, there was a member in a trading room, not to pick on him, but he had heard from, I'm assuming, another educator. He read somewhere that you should trade in the direction of the gap after a daily doji. Well, that's true, except for when it's not. And quite frankly, it's not often that true when it comes to the indices. It really is more dependent upon market conditions. So that's this data point shows that clearly. Roughly a 7% chance of filling the gap. And even if the gap is large, the numbers are strong. Because we were right on the parameter of a large gap day. We're opening right at 1694. So bottom line, slightly attractive guides. Worksheet unique pattern data above, mostly favoring up gaps. Overall, historically attractive, but NASDAQ was concerned, large gap size was concerned, and this unprecedented bullishness this year. We have not had many winning up gaps this year. So key risk, so that was enough to make me trade half-size position. And I said I'd like to hold some extended target, and may use a slightly bigger stop depending upon the open. Okay, so now that we've said that, let me take you through the action. I went short at the open, was filled with 1 tick of slippage at 1693.50. Was my fill. You see these other markets, Russell, NASDAQ, and Dow. Whoops. And Dow, which just barely filled. Filled short and did not take much heat. Originally set it up to scale out aggressively about half at the extended target, but there was a ton of confluence from our price guides here, so I changed my plan. Not changed my plan, I do this. This was built into my thinking, I should say. So in my mind, that was the plan to evaluate, which is normally what I do. I evaluate and tweak my stops and targets after I'm in the trade. Focus for me is always on selection. And once I realized there was so much confluence here, I went ahead and moved, so I was only going about 75%, 1 tick above the close. And then when I realized that my extended target was at 1688, that was also just underneath all this confluence. My thought was if we broke through that, it'd likely go down to 1666.50, at least 1666.50, a point above the prior lows. Kid you not, I explained this in great detail this morning. And then I realized, once my first target had been hit, for plus 2 3/4 points, I realized that I had miscalculated. The extended target was at 1689. It's just the difference, real quickly, between the close at 1690.5, subtract the extended target, which was 1.5 today. So that equals 1689. But I took 1.5 points, subtracted it from the open, 1689.50, so made it 1688. As soon as I realized my error, I realized there was absolutely no compelling probability-based reason to hold for this original target 86.50, where I had moved it for the rationale that or reasoning that I just explained. So without a probability-based reason, I was just gambling using a little bit of gut and market experience, and that's okay to do, but not on my core gap trades. Right? I need to do that on a different account or take it with a different trade. So I closed it right at 1690.5 for 3 points on that, so 3 points on the entire win. A nice half-size win today for 3 points. And range guides came out. Nothing else looked attractive whatsoever. Left it alone. Just show some data that showed that market historically after dojis during bullish markets tend to get weak in the last couple of hours, especially if you're below the open. And that's exactly what happened today. And I think some people did profit in the trading room on that. I did not trade. I was very busy in research, but a nice profitable day. I caught that gap in I think all of my accounts, which is always good. And which is my point to you, not to brag, is that it was this obvious of a good setup to me, even though I was a little fearful Well, actually, I wasn't fearful. I was fully accepting, but I certainly recognize that up gaps have sucked all year. But I'm going to stick with my plan. Just like I said in my quarterly wrap, if you didn't get that, sign up on our mail list. That's the only thing I know to do that has worked consistently for me over many years and many market conditions. And today it paid dividends. So that was my day, and that is the wrap for Tuesday, July 23rd.